This is the beginning of Liberation Day in America. We're going to take back just some of the money that has been taken from us by people sitting behind this desk or another desk.
Hello and welcome to the week ahead on Nomura Podcasts. I'm your host Andrew Ticehurst from our Global Markets Research team, and today is Friday, 28 March. Well, global markets have largely chopped around in the week to date, I think mostly as we wait for President Trump's tariff announcements on April 2. He's calling it Liberation Day, as you heard there. So far this week, US bond yields are a little higher across the curve, and the US dollar has been a little stronger too, while equities really have had a couple of up and down days. A second big theme for global markets has been around the idea of US exceptionalism. That took a dent as some US data printed weaker, Europe data looked better, and as China and Europe announced some stimulus plans over prior weeks. But most recently, I think Fed Chair Powell has calmed fears of US recession, and some recent US releases have helped on that front too, with our team there marking up the Q1 GDP tracking this week. I think some of that sentiment has been a driver of markets supporting those market moves. Now, for the week ahead, it really is crunch time with April 2 tariff announcements just around the corner. So we'll be checking in with some of my colleagues in the US, Europe, and in China to talk tariffs and to get their thoughts on the latest macro developments and what could come next. It really is a big week ahead, and it could deliver some material market moves. So let's dive in. All right, let's start at the epicenter, the US, and I'm joined here by Jeremy Schwartz from our New York-based research team. Jeremy, I know Republicans use the image of an elephant as their symbol, and tariffs are certainly the elephant in the room right now for Trump's Republican Party. What are the things to look out for with respect to the tariff announcements next week?
Sure. So, next week, April 2nd, Wednesday, is when tariffs, the reciprocal tariffs that Trump has hinted at are likely to be detailed and announced. There's a lot of uncertainty over what exactly this entails, what is going to be the formula that goes into calculating these reciprocal tariffs, who are going to be the target countries, and how exactly these tariffs might interact with other tariffs that Trump has already announced or might announce in the future. Our expectation for the cumulative effective tariffs is that it brings the effective tariff rate up to around 14% or so, peaking later in the year. We think that would be consistent with something like a 10 to 15% reciprocal tariff on not every trade partner, but the 15 or so trade partners that seem to be singled out in conversations with the Trump administration for having large, persistent trade surpluses with the U.S. So we would think of that as a quasi-universal tariff. Based on reporting, we think that the tariffs are likely to be country by country instead of focusing on sector-specific tariffs. We think that the tariffs are likely to kind of replace some existing tariffs, which have already been announced, particularly against Canada and Mexico. And we think that they can be implemented relatively quickly through emergency powers, with Trump likely to continue to emphasize further escalation as more likely than any future de-escalation. That said, really any of those five dimensions, who it's targeting, what the target rate is, how it relates to existing tariffs, how quickly it can be implemented, and whether the messaging is that tariffs will rise or fall in the future. Any of those could kind of soften the announcements on the positive side, or potentially make the outcome far more aggressive and negative than we're anticipating. So far through the trade conflict, tariffs have evolved relatively in line with our expectations, but we have to admit that the announcements have come much faster than we have expected, and with a lot less advance warning in many instances. Notably this week, we had an announcement of auto sector tariffs, which didn't seem to be on the docket until after the April 2nd announcement. But that really accelerated quite quickly, with some indication that there would be an announcement early in the day, New York time on Wednesday, and an announcement coming around 5 or 5:30, putting 25% tariffs on autos and likely auto parts in the future. So again, I think our takeaway is that this is still a fluid situation. It's still escalating. Next week is likely to mark one of the more significant steps in the trade conflict process, but there are a lot of known unknowns in terms of these 5 dimensions of the trade announcement, and really any one of those could lead to a kind of worse outcome or a potentially kind of more benign message to markets that the administration is getting a bit more concerned about downside risks to growth, potential inflation, and of course the risk that rapid escalation of tariffs might cause some market stress.
Got it. Known unknowns. I like it. There's obviously a lot to look out for, and it would not be surprising if we get a few surprises, I guess. Hey, next week we get the ISM reports too, and I wanted to single these out because I thought they might be interesting in the context of the US growth exceptionalism theme. What could these ones show?
Yeah, so we do expect both ISM manufacturing and services are likely to slow, with manufacturing in particular dropping into contractionary territory. We have seen a real loss of momentum in cyclical indicators on the soft data side. So clearly business sentiment seems to be concerned about the extreme uncertainty around trade policy, as well as risks like DOGE, fiscal spending, regulation, and just a great deal of uncertainty about what the policy mix looks like over the next couple of months, quarters, and years. So that is hurting sentiment. We've particularly seen forward-looking measures of sentiment kind of drop sharply and reverse their post-election gains. And we think that that weakness can continue. Regional surveys and the flash PMI have been negative for manufacturing. And on services, ISM had been a bit of a positive outlier and likely has some room to catch down. We've already seen respondents to the ISM survey seemingly very concerned about their future outlook amid the policy haze. That said, I would say the hard data so far has not followed the soft data lower. We've gotten pretty solid reports on the housing sector, industrial production, and durable goods orders and shipments were both solid in the latest round of data. So it's possible that we could be getting some decoupling between survey data, which could be a bit more geared to news headlines relative to hard data, or it could just be that the shocks are coming so hard and fast that the soft data is going to lead and hard data will take a couple of months to catch up. Our expectation is that things slow. We expect growth, headline growth, cyclical sector growth, and employment growth to kind of drop below trend over the next couple of months. But again, a little bit of uncertainty about how much follow through you're going to be getting on this sentiment cooling.
Got it. And just on the hard data, it is payrolls week, so we better not leave that one out. We've got the lead up, of course, with JOLTS, ADP, and jobless claims, but then the big one, payrolls on Friday night. What are you looking for from that one?
Yeah, this must be the first time in a while we've saved payrolls for last on the podcast. We expect non-farm payrolls growth likely slowed to 110K in March. That would be the lowest monthly reading since October 2024. And it would bring the 3-month average just below 130K. So really a market slowdown from the high hundreds pace you ran at in the last year or so. Government employment in particular is going to be interesting. We think that the federal hiring freeze and some layoffs from the Department of Government Efficiency, DOGE, are likely to be a headwind this month. But that said, there's a big discrepancy between headlines and news reports of really widespread layoffs in the tens and maybe hundreds of thousands versus some of the tracking indicators we're seeing in weekly and daily data, which shows some impact, but much more modest, a couple K here and there. We do think that this is a negative. It's likely to be persisting as a negative, but potentially less severe than some of the early indications of widespread government layoffs would have had markets believing. In terms of the unemployment rate, we think that that is likely to continue to drift higher. It almost rounded up to 4.2 in the latest report, and we do think it gets there in March. There's been some encouraging signs that hiring has stabilized after a long slowdown over the past couple of years, but it does seem like job losses and layoffs have drifted higher, and that should put some upward pressure on the unemployment rates. And then lastly, to flag, labor income has been quite soft the past couple of months. We think that that improves in March with the work week rebounding after a drop off in January and likely solid average hourly earnings growth. So overall, it's a weak report, but not a catastrophe for the Fed, not something that's going to put them on the back foot and force them into a reactive easing posture. We think that things are cooling, but not falling off of a cliff. And as long as household income growth is still doing well, then consumer spending and household finances should remain solid. We think that growth momentum is slowing, but muddling along is more likely than a more severe downturn.
Got it. Well, it certainly is a big week ahead. Thank you for covering all of that for us.
Yeah, thank you.
Now let's jump across to Europe, and I have Andrei Stepaniak from our European research team here with me. Hey, Andrei, we've been talking tariffs ahead of April 2, and Trump has told us that Europe's in his firing lines. So I wanted to ask, should people in Europe be nervous from a growth perspective, and how hard could Europe push back?
Hey, Andrew, great to be on here. I think that's a great question. In terms of our house view, look, we're expecting 10% blanket tariffs from the US onto Europe, and that we think could hit European growth by 20 to 30 basis points cumulative over 2025 and 2026. Obviously, that's the direct impact from essentially export shares. However, if you account for uncertainty, that could be even higher. And a lot of the academic literature underscores uncertainty can actually be worse or more of a hit to growth than the actual direct tariffs themselves. But what I will say is this: a lot of what Trump's been announcing so far has been sectoral and also higher versus our baseline. And if he hits the sectors where we export the most to the US, say autos, say pharma, these sectors, that can be a worse hit to growth versus just blanket tariffs. And that we have to be careful about. In terms of Europe pushing back, they definitely will. Europe has been clear they will retaliate like for like. 100%.
Got it. On the data front, I see CPI is out next week. That could be a highlight. Have you got a view there?
No, certainly. Look, for quite some time now, we have been underscoring inflation is of secondary concern in the euro area. We're forecasting the March flash print to come in at 2.2%, so almost at the ECB's 2% target. In terms of services inflation, which the ECB is heavily focusing on, we're forecasting that actually decline about 1 to 2/10. So underscoring that underlying momentum is slowing in inflation, and that's based on the fact that obviously we've seen wage growth slow, firm pricing power is diminished. All of these factors are doing essentially what the ECB was hoping to do.
Got it. And finally, just on the ECB, I am curious about what they're going to make of all this, weighing up growth versus inflation concerns and how they might respond to. I see on the calendar there are a few ECB speakers out next week, including some heavy hitters, including Lagarde and Schnabel. Could you share some quick ECB thoughts with us?
No, sure. Look, in terms of market pricing, markets are pricing essentially 37 basis points cumulative over the next two meetings. We forecast a skip in April and one further cut, the final cut for a depot rate of 225 at the June meeting. Look, in terms of the ECB speak, it's finely balanced. The data has been mixed. Some of the data suggests a cut, some of the data suggests a pause, and some of the ECB speak so far has underscored the need to slow the pace of cutting as we are essentially so close to neutral. But I think essentially, so Mueller put this recently, it depends on Trump. If you see really punitive tariffs, that could force the ECB's hand. If you don't, then obviously it supports a pause as we've forecast.
Okay, got it. Hey, Andrei, I know you've been fighting a bug there over the last day or two. I appreciate you coming on and speaking with us. Thanks so much.
Thanks, Andrew. As always, talk soon.
So let's bring the focus to China. And I have the very cool and well-informed Harry Zhang here with me from our China research team. Hey, Harry, thanks so much for being here.
Thank you, Andrew. Very happy to talk to you.
Excellent. Thank you again. So question one, we're talking tariffs this week, and President Trump has already been pretty aggressive on China with 2 10 percentage point increases in tariffs, plus those tariffs on steel and aluminium, which stack on top of that. Now, the response from Beijing so far has been pretty measured. But with further tariff announcements coming on April 2, I'm wondering if the authorities there could start to run out of patience. Do they have a lot of ammunition to respond, and would they be willing to deploy that?
Yeah, thank you. Thank you for the question, Andrew. So first of all, next week will be a very important week. in terms of Trump's policy on trade. So first, on the 1st of April, the review under the American First Trade Policy Memorandum will be concluded with the results of all those assessments delivered to the White House. So if you still remember, the American First Trade Policy Memorandum has a particular focus on China. And it is, however, uncertain what Trump is immediately going to do next week. So the 1st of April deadline could imply that only the results need to be sent back to the White House for further inspections and studies, or it could imply certain policy actions to be announced immediately. So there is still a possibility that Trump may only signal the findings of the review, but not initiate actions immediately. But overall, the conclusion of this review should give us a better understanding of Trump's grand strategy and policy response to China on the trade issues. So far, the 20% tariffs imposed since Trump returned to the White House have only been associated with the fentanyl issue as cited by Trump himself. And then on the reciprocal stuff, so Trump plans to announce this policy on the 2nd of April. Actually, this reciprocal tariff is not primarily targeted at China. So with our estimated average Chinese tariff rates on the U.S. at 22%, and the average U.S. tariff rate on China at 33%. So we believe the reciprocal tariffs that Trump is set to announce are unlikely to have a material impact on China. So unless Trump treats the recently imposed additional 20% tariffs separately, even when accounting for the reciprocal VAT rates, where China has an average of around 9% compared with around 6% in the U.S., the difference would be more than offset by the disparity in the corresponding tariff rates. In terms of retaliations, so if tariffs are immediately imposed next week, we think Beijing is likely to follow a similar strategy as it did in early February and early March. So those include tit-for-tat tariffs and further export controls or outright export bans, launching investigations against more U.S. firms and possibly putting more U.S. entities on its so-called unreliable entity list. And then for retaliatory tariffs itself, as you mentioned, it has been pretty measured and restrained so far. So we actually published a report this week. We evaluated China's capacity to substitute U.S. imports with alternatives from other countries at the product level. So basically, we found that some substitute options exist for certain products, but for a number of products, such as soybeans, integrated circuits, and commercial airplanes and jet engines, viable alternatives are quite scarce and would take years for other suppliers to scale up. So overall, Beijing's restrained approach to retaliatory tariffs appears sensible in our view, given the limited availability for substitute. So we think this strategy is likely to continue.
Okay, understood. And thank you for sharing those statistics around reciprocal tariffs. So on the reciprocal front, at least, things might not be too bad for China. Now, just turning briefly to the data front, we have some PMI reports coming out for China next week. Growth momentum seems to have been pretty good so far this year. What are you expecting from those reports? Could a decent growth trend continue? And what's likely over coming quarters as those tariffs start to kick in?
Yeah, thank you, Andrew. So on PMI and growth prospects, so we will have China's PMI released on Monday next week. So we basically expect the official manufacturing PMI to remain in expansionary territory. So the trend is likely to continue, despite with a slight decrease to 50.1 in March from 50.2 in February. This is in view of the stronger than euro increase in the emerging industry PMI, the fading of export front loading, as well as a post-Chinese New Year holiday adjustment. So February's PMI increase was partly boosted by the Chinese New Year holiday. And then we expected the official non-manufacturing PMI to slow to 50.3 in March from 50.4 in February, but still remain, again, in expansionary territory. And then for growth, so we expect China's GDP growth to be 5% year over year in the first quarter. So if you think about that, our annual GDP forecast is at 4.5%. So 5% in Q1 is definitely represents the peak of growth this year. This is in our forecast. So we expect GDP growth to slow slightly in Q2 to 4.8%, then down to 4.2% in 3% and 4% in Q4. So it's clearly a downward trend. But in the first half of this year, we think it's likely to be okay. Yeah, and to be more clear in terms of the expectation on growth, as Beijing aims to achieve this around 5% growth target, and the first year actually under Trump 2.0. Boosting domestic consumption tops its policy agenda. So all the 300 billion RMB incremental funding from ultra-long special CGB issuance for this year will be used for extending the consumer trade-in program, which is clearly the focus of the market at the moment. But in our view, the boost from the scheme is unlikely to be sustained, with a significant payback expected in the second half of this year. Except in several lucky top-tier cities, the property sector is still contracting, basically, impairing households' confidence in their future income and wealth. Meanwhile, the ongoing U.S.-China tensions, as we just discussed, may erode external demand, dampen domestic investment as well, squeeze manufacturing margins, and dent workers' pay. So overall, we think the economy still face formidable challenges for the course of this year. But in the near term, we think things are likely to look okay.
Okay, got it. Near term okay, but a slowing a trend as the year proceeds. Harry, you've covered a lot of ground there. Thanks so much.
Thank you, Andrew.
Now, elsewhere across the broad Asia region, we're going to zoom in on just two countries. First up, Japan, where my colleagues have been hosting a rather large conference in beautiful Kyoto this week. I have been chatting with them, and they are waiting to hear about reciprocal tariffs on 2 April. They estimate that a 10 percentage point increase in the US's effective tariff rate on all Japanese exports could take a tenth off real Japan GDP growth, and possibly more, if heightened uncertainty leads companies to scale back on their capex plans. What could that mean for the Bank of Japan and the policy outlook? Well, let's have a quick listen to former BOJ Deputy Governor Masazumi Wakatabe, who was in the media recently.
I would not exclude the next meeting that would be held on the May the 1st, because that would coincide with the release of the economic and price outlook report. So I think that the early signs show that the wages would increase furthermore.
We'd note that the Bank of Japan has been gradually normalising policy while checking that the economy and prices are on track and moving in line with its expectations. Our base case is for the next 25 bip rate hike to come in Japan in July, and we think the governor has been trying to strike a balanced tone. We concede that an earlier May hike is a legitimate risk, as discussed there by Wakatabe-san, and noting that wage developments will be important, as he flagged. But equally, we think risks around our July call are fairly balanced, and there's a risk that the next move could come later than July. And then finally, on the data front for Japan, there are a few releases to look out for next week. Our team expect industrial production there to rebound in February, up 2.8% in the month. That would, however, leave industrial production down a little in Q1 compared to Q4. We'll also receive the Tankan survey of business conditions. We expect the measure for large enterprises to show a drop for manufacturers, but a rise for non-manufacturers. Overall, we think that the report could point to some stalling of growth momentum in Q1, but our base case remains that growth will return roughly in line with potential from Q2 onwards, though we really would like to see the following Tankan report for more clues to get a better sense for how business sentiment is being impacted by those auto tariffs in particular. And finally, we think unemployment stayed at 2.5% in February. We think labour demand remains solid, despite some concerns about economic slowdown, and noting that Japan is continuing to deal with serious labour shortages. And finally, I'm going to invoke the Speaker's privilege and shine a light on my home, Australia, because the Reserve Bank of Australia board will meet again next Tuesday. We're very confident it will announce an unchanged cash rate of 4.1%. Our activity data have generally steadied, and it has likely not received enough evidence of any further moderation in inflation, which would justify a second rate cut. Its first rate cut in February was driven by a view that underlying inflation pressures were moderating, and confidence in that view may have been shaken by the February CPI indicator report, which was out here this week, suggesting some upside risk to inflation in Q1 in our view. Accordingly, we think the governor will likely continue to push back against current market pricing, which indicates around 63 basis points of easing this year. We do continue to forecast a 25 bip rate cut at the following meeting in May, but we now consider that to be a line ball call. So there you have it, short and sweet, our views on major market themes and what to look out for next week. Written by Andrew Ticehurst and the Global Markets Research team, expertly edited and produced by John Dalton. Thank you for listening to our podcast. If you did enjoy listening to the show or want to hear more from Nomura's economists, researchers or investors, please like and subscribe to Nomura's podcast on Apple, Spotify and SoundCloud or wherever you get your fill of podcasts. If you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log on to nomuraconnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.